Ever since interest rate cut was expected, all the Singapore REITs prices have started rising. We can see that S-Rate Index has been on a very good run in recent months. But in my opinion, not all REITs are actually doing well even though their share prices are increasing. The fundamentals of the REITs do not look as good as their increase in the share prices. In this video, I'll take a look at a few REITs which I shortlisted as the best REITs that should perform well and continue raising their dividends in the long term. I'll go through each individual REIT on why they are increasing their dividends and summarize what are the factors I look into when viewing these REITs for the long term. Let's go on to the first REIT, which is my favorite, and that is Mapletree Industrial Trust. MIT is one of the REITs that is attractive to me due to one simple reason. That is their expansion into data centers properties while having other high quality assets like high-tech buildings. Having different assets gives MIT the flexibility. On top of that, they also have a very strong sponsor, and that is Mapletree. Now, what is the focus for MIT's potential? It is their data centers. Recently, they have bought Osaka DCs, which is already performing very well. With the Phase 3 fit-out work completed, I expect Osaka DC's contribution to continue rising in MIT's income. Phase 4 will be completed in 2025, which is another potential growth in their income contribution. However, one thing to note about this property is that committed occupancy is at 100% of the same tenant. So there is definitely a slight risk to ensure that the tenants are able to pay the rents. Another potential growth that is lacking is their US data centers. So why do I say that even though their income and occupancy is dropping? The main reason for the drop is due to power constraint rather than demand problem. One way to see is that passing rental rates continues to increase, which shows the demand. At the AGM, it was $2.44 per feet, while the rental rates reported in the results increased to $2.49 per feet. In the Q&A, the management has mentioned about how big of a difference it is in terms of the demand in AI development. Imagine the original consumption was only 2 to 3 kilowatt per rack. However, because of the recent AI development, now the new demand is 50 to 60 kilowatts per rack. This is a 25 times higher increase in demand for energy. This is something that I'm confident in the long term the US will be able to solve. They have mentioned that the government has been simplifying permits and renewable energies has been promoted to address the energy constraint problem. Another small good point is that because of the valuation drop in the properties, taxes for those properties actually drop as well. Therefore, in the long term, as the government resolves the power constraint issue, I'm confident that MIT's data centers occupancy will start coming back. Therefore, the drop in the valuation is not a concern, as its drop is not due to lack of demand, unlike US commercial and retail properties. Next, another potential is the Mapletree High-Tech Park at Kallang Way. Although they have stopped updating the occupancy, it seems like it continues to deliver with good leases. This can be seen from the new strong leases that continues to come in higher, which definitely will bring in more income for MIT. The last factor is the potential for better leases renewal. We can see that MIT assets leases continues to perform well for both renewal and new leases. Moreover, I also expect their data centers leases to continue performing well. The next REIT I would like to talk about is Keppel DC Reit. Keppel DC Reit is a good pure data center REIT that have properties in various countries. It has been a very attractive REIT as data centers is demand due to the advancement of AI. Unfortunately, due to their assets tenant facing default issues, I was worried that the temporary loss of income from their 7% of their assets will affect them. However, in their recent earnings, they have actually managed to declare higher dividends at 4.459 cents. Rental reversions was amazing at 40% increase for a major contract in Singapore. This emphasizes how in demand are data centers, which is good for both Keppel DC Reit and MIT. With such a large rental renewal, it will definitely boost the REIT's income. Moreover, if we look at the lease expiry portfolio, there is 20.4% of income that will be expiring this financial year. This might potentially be a big catalyst for Keppel DC Reit if they manage to renew these leases with a 40% increase similar to the recent major contract. On top of the huge potential in rental reversions, they have also bought one data centers in Tokyo which is expected to be completed and start contributing to Keppel DC Reit's earnings by next quarter. This is good because not only is it at 100% occupancy, it's also under the triple net lease. What this essentially means is that the tenants will pay for all the expenses such as utility bills and insurance. This is good as this will ensure that the operating expenses of the building will not pass on to Keppel DC Reit. If we look at their results, revenue and NPI both grew greatly from last half comparison with 11.7% and 12.8% increase respectively. Both was tremendously higher due to the huge potential rental reversion and the inclusion of the settlement sum from another tenant payment lawsuit. Property expenses and finance costs increased by 6% and 2.1% respectively, which is slower as compared to the revenue growth. Therefore, it resulted in a higher distributable income of 5.9%. With the potential for more rental reversions and new Tokyo data centers, I will not be surprised for their distributable income and dividends to be declared higher for the next half. With interest rate potentially cutting, this will also definitely be beneficial for Keppel DC Reit's debt maturity profile. They will only need to refinance next year and 2026, and when that time comes, I expect interest rate to have come down quite a bit. This might potentially bring down their finance costs and expenses, which will mean more income to distribute to shareholders. Overall, I think that if the leases expiring this year continues to increase at a very good rental reversion rate, and on top of that with the potential from the Japan assets, Keppel DC Reit's dividends have the potential to reward shareholders with a higher rate. With interest rate coming down, the safe yield from different assets will drop. For those with ideal cash that wants a higher yield, Moo Moo Cash Plus is definitely a place you can consider putting your money in. This also supports my channel by using my link. It guarantees up to 6.8% yield for the first 30 days. That is higher than some of the dividend equity in Singapore and not bad for a short-term return. These funds can also be redeemed with no lock-in periods. Existing users will also get to enjoy the promo by putting in fresh funds of at least $10,000 and maintaining it for at least 60 days. For new users to Moo Moo, there is also a starter promo kit for you. By depositing $100 and making just one buy trade, you will get $20 cash coupon. Similarly, if you deposit $3,000 with 3 trades, you will get stock bundles worth $70 with fractional shares from stocks such as Apple, Nvidia, Tesla, AMD or Microsoft. Making $10,000 deposit with 8 trades will get you $210. So let's start your investment journey with Moo Moo and sign up with my link today. The third REIT that I potentially feel that is good is Capitaland Integrated Commercial Trust. Even though they have a lot of retail properties, but what makes them perform so well is because the properties are located in Singapore. CICT is a REIT that focuses on retail, offices and hotels. What makes them unique is that they have 94.3% of their revenue contributed from Singapore properties, which is the main reason why they are one of the better performers in the Singapore market. With the last quarter rental reversions to be in the 9% range, I would not be surprised if this trend still continues. Why is that so? It's because of the attractiveness of the retail malls that CICT holds. This is one of the main reasons why CICT still managed to increase their revenue and net property income without any additional assets or assets improvements. To add on to the list of their amazing Singapore malls, they will most probably buy 50% stakes of Orchard Ion, which will further solidify their Singapore assets. This purchase will be at a great valuation of $1.8 billion from their sponsor, Capitaland Investment. This shows how important sponsors are to REITs. Sponsors play a very important role in managing their REITs well by selling them good properties at a reasonable valuation. However, there are some REITs which are not so good as they will issue out lower quality properties just to earn money from the open market. So beware of the sponsors that you are buying into for the REIT. With this Orchard Ion purchase, it will be DPU accretive of 0.9% for shareholders. This would mean an increase of the dividends from 5.43 cents to 5.48 cents. Because of the strong performances in Singapore retail properties, leases expiring are good for the REIT because they can be renewed at a higher rate for higher income. This will definitely help in bringing in more income for CICT and thus more dividends to shareholders. Therefore, for CICT, with their revenues increasing due to good rental reversions, operating expenses dropping due to lower utility, their DPU should continue to do well. If you are interested in a more detailed analysis that I went through recently, you can see my previous video linked at the top. The next REIT that I would like to talk about, which is quite similar to CICT, is Fraser Centrepoint Trust. Similar to CICT, they contain only Singapore malls in this REIT. This is why it makes them so strong as a REIT because all of the REITs are performing well with close to 100% occupancy rate. Moreover, because of the strong performances in their malls, most of the rental reversions are coming in strong. Similar to any REITs with strong positive rental reversions, it's good when there are leases expiring because this means that renewed leases will come in at a higher income for the REIT. But why am I so optimistic for FCT to increase their dividends in the coming quarter is because of two main reasons. Firstly, is the contribution from Tampines 1 that will come back soon with the enhancement project finishing. Tampines 1 is a very big mall and I expect it to contribute back to FCT big. The next reason is because of the purchase of 25% stake in Next from their sponsor. Moreover, it's expected to make contribution to FCT as soon as this half, so additional income will definitely benefit FCT. Both FCT and CICT are quality REITs that are currently priced at dividend yields around 5%. In the long term, they should continue doing well and increasing their dividends over time. The only potential concern I have is the impact of the RTS construction to JB that it will have on them. But that is down in the future and we will see if it really impacts Singapore malls. The next two REITs are subjective because currently they are experiencing drop in dividends. These will be Mapletree Logistics Trust and Mapletree Pan Asia Commercial Trust. So even though they are good REITs, why are both of them experiencing drop in dividends? Both have a common issue and that is their overseas properties are not performing well. If we see the rental reversions for MLT, China leases are still performing terribly with negative 11.3% for Q1 while last quarter was negative 10%. Moreover, for MLT, Hong Kong, China and Japan is quite a large part of MLT's overall portfolio. But in terms of rental renewals, all of them are not performing as well as expected with Japan at 2.3% and Hong Kong at 2.1%. With quite a lot of leases to be renewed, it is to be seen how the rental reversions will perform in the next few quarters. One of the main issues is that majority of the lease expiry will be China leases. The management has also mentioned that they expect the negative rental reversion trend to continue for the China market leases. So we will expect rental reversions to be continued in the negative range. This will be one of the main factors that will definitely make or break for Mapletree Logistics Trust. On the bright side, with MLT being so diversified in different countries and in the logistics sector, it brings about stability and reliability even in tough market conditions. They are a very solid REIT, just that they are being pulled down by the China economy. MLT might continue to experience dividend drop in the short term, but in the long term, I will not be worried about MLT's performances. Next, for Mapletree's Pan Asia Commercial Trust recent Q1 results, they have similar issues like MLT. They have 40% of their contributions from overseas properties, in particular 30% in China and Hong Kong market. If we look at their current rental reversions, MPACT's portfolio performance seems worse than MLT. The reason is because all of their overseas properties are experiencing negative rental reversions. Hong Kong is coming in at negative 5% while China is coming in at negative 1.3%. Therefore, it's important that there must be some actions taken by the management in order to prevent these negative rental reversions from continuing. The bright side is that because their Singapore property leases are coming so strong, it managed to offset the drop in the rental reversions from their overseas properties. That is why if we see their results, revenue and net property income did not have much change year over year. This is very impressive considering 40% of their assets are actually experiencing negative rental reversions. But they have another issue, and that is their finance costs came in 9.8% higher year over year, which resulted in a drop of 3.5% in their distributable income and 4.1% drop in dividend. For MPACT, it is to be seen with portions of debts that needs to be refinanced. With the interest rate coming down, this might be good for MPACT for those loans in financial year 25-26 onwards. But for now, the loans that will be renewing this financial year might continue to cause their finance costs to increase in the short term. So why I included MPACT and MLT in this list is because they are two very good REITs with reliable sponsors Mapletree that will be able to do well in the long term. But in my opinion, what are the possible situations that will allow them to make a comeback? First, China economy must improve so that both REITs income will come back. Next, when interest rate cuts, Singapore currencies might weaken against other countries. This will mean that overseas properties will be able to bring in more income as they are converted back to Singapore dollars. Secondly, with the interest rate cuts, loan renewals will be cheaper and this will stop the increasing of their finance costs. With these factors, MPACT and MLT might be a good purchase for the long term. So looking at these REITs, what do they have in common? 1. The very important thing is that their properties have to be attractive. This is what gives them the power to increase the rentals when tenants renew the leases. So REITs with the power to renew their leases higher should always be a good thing when their leases are expiring. One of the prime example is the demand for data centers. Second, growth of revenue must be higher than the growth of the expenses. Expenses are mainly operating expenses and finance costs. Operating expenses are examples such as utility, maintenance fee, while finance cost is the payments made to their debts. With interest rates starting to come down soon, most of the REITs will definitely see the slow or even the decrease in the growth of their finance costs. This will potentially lead to the growth in dividends for those good REITs which we are already seeing into effect. Lastly, a strong sponsor is always preferred when it comes to investing in REIT. Why? It's because sponsors are able to sell good properties to their REIT at reasonable valuations. Moreover, with a strong sponsor backing, banks will be more willing to loan the REITs money as well. Thank you so much for watching. I hope this video brings about good insights into your investment journey into REITs. You can watch my other videos where I do an in-depth into the individual REITs or Singapore banks as good dividend stocks. Thank you, and I'll see you in the next video.